think that DCAing into that shitcoin is safe? You think setting tight stops on everything protects you from big losses? Yeah, think again, fella. You're bleeding money slowly. And the worst thing is that you don't even realize it. Today, we are exposing the strategies that feel safe but are mathematically designed to drain your portfolio over time. Crypto gurus love selling safety, strategies that feel disciplined, they feel low risk.
Dollar cost averaging, or DCA.
One of the most important strategies in investing is dollar cost average.
Not even God can beat dollar cost averaging.
Trading strategies that allow you to use tight stops.
That's going to be your stop loss level, and then a 1 to 2 risk to reward ratio minimum.
But let me tell you, often this safety is an illusion, a very, very dangerous one, because it's designed to make you comfortable while you slowly bleed out your capital. Today, we dissect two massive culprits: mindless DCAing into shitcoins and strangling your trades with ridiculously tight stop losses. These aren't safety nets, they are negative EV traps. Trap number 1. DCAing into nonsense. The mantra, just keep buying the dip, sounds smart, right? Lower your average cost. Lovely. Except when the dip is a concrete parachute plummeting your broke ass into a live volcano. Because you do know that not all dips recover, right? When fundamentals break, tokenomics explode, hacks drain treasuries, founders vanish. When those things happen, DCAing is just feeding a black hole. You're not investing, you're pissing your money up against the wall and then lighting it on fire just for good measure. So let's use our old friend and yours, expected value. Assume, and this might be generous, but let's run with it anyway. Assume a dying coin has a 30% chance of a miracle 2x dead cat bounce from current levels, meaning a 1x profit. And let's say that it has a 70% chance of going to zero, meaning a 1x loss. See? When we run the numbers, this is a negative 0.4x, which means that every dollar you average down is mathematically expected to lose 40 cents over time. The safety of DCA is pure psychological garbage. Garbage that's covering a losing bet. Safety, let me tell you, it would be safer to use a lightning rod as a fucking selfie stick during a thunderstorm. Trap number 2. Strangling trades with pointless stops. Now, gurus say use tight stops, risk tiny amounts. Feels safe, right? Small losses. Except crypto is, quite volatile, isn't it? So setting stops based on your delicate feelings, I can only afford to lose $50 on this trade, instead of setting stops based on actual market structure, that means you're guaranteed to get wiped out by random noise. See, market makers hunt these clustered stops for breakfast, and your sorry ass is on the menu. Let's think EV. You set a super tight stop, say risking 1R. To make it worthwhile, which is to say that the trade has positive EV, you need a decent probability of hitting a larger target, say 3R. But the very volatility that requires a wider stop makes it pretty unlikely that your tight stop is going to survive long enough to reach that 3R target without getting taken out by noise first. Your actual probability of reaching 3R with that ridiculously tight stop might plummet to 15, maybe even 10%. Let's calculate the EV with that more realistic probability. Look, negative EV again. The safety of small loss is a mirage because it drastically increases the probability of taking that loss repeatedly. This again is death by 1,000 tiny pointless cuts. So why do people fall for these traps? And they do, they fall for this stuff all the time. Well, it's because people prioritize emotional comfort over mathematical edge. Mindless DCAing feels proactive. Averaging down feels smart, doesn't it? Tight stops feel safe because your losses are small. But feelings, they don't pay the bills. Not in this market, do they? And that right there is the DCA trap. It ignores the probability term in the EV equation. Now, of course, DCA can work, but only on assets with a high probability of long-term survival and of growth. Applying DCA blindly to dying shitcoins means probability is destroying your EV, no matter how low your average entry gets. Now let's look at the tight stop trap failure. It screws up both probability and reward. Tight stops increase the probability of getting stopped out by noise. And this will happen before your trade idea even plays out. Tight stops will naturally force you to aim for smaller rewards because larger ones are unreachable before getting stopped out, aren't they? Just think about it. And all of this only serves to further crush your EV. So think about your stops. You have to place stop losses based on either market structure, levels that actually invalidate your trade idea, or on statistically backtested and out of sample generated results. And to be clear, these are based on math, not on arbitrary percentages that you pulled out your arse on a quiet Thursday morning. So what's the alternative? How do we escape these negative EV traps and find genuinely positive EV strategies? Well, and this is important, stop confusing comfort with edge. True positive EV strategies often feel uncomfortable because they require accepting the possibility of larger individual losses, which are of course controlled by position size, in exchange for either a higher probability of success or much larger wins. So instead of DCAing blindly, apply fundamental filters. Is this project active? Is the tech sound? Does it have real users? Only DCA into assets that pass rigorous checks and that have a history of recovering. For every ADA, there are 5 that look like Luna. And instead of arbitrary tight stops, place stops logically. Where does price need to go to prove that your initial trade idea is wrong? Put the stop there. Below key support, above key resistance, based on volatility metrics, maybe like ATR. If you can, place your stops based on statistical market analysis. Again, this is where backtesting and out of sample testing come in extremely useful. I was always taught this. Never, ever get into a position without knowing what you would need to see to convince you that you were wrong and that you had to exit the trade. The positive EV mindset means sometimes stops need to be wider, which means your position side must be smaller to maintain proper risk per trade. How can I say this? Projects that are objectively crap need to be sold, not bought more of. The game is won by optimizing for long-term mathematical expectancy, not for short-term emotional comfort. Remember, professional poker players don't win every hand. Obviously they don't. They win over time by consistently making positive EV decisions and letting the math work for them. All right, key message today. Do not confuse low volatility or small individual loss size with actual positive expected value. A strategy isn't safe if it's mathematically designed to lose money over the long run. Remember, blindly DCAing can kill your capital. So filter for the fundamentals. Stops must respect market structure and math, not your fragile feelings. True safety equals positive expected value, positive EV, and optimize for math, not for comfort. Okay? All right. So next time we go on the offensive. I will show you how to identify genuinely high probability setups in crypto, the equivalent of finding ace-king suited at the poker table, giving you a real mathematical edge before you place that trade. In the meantime, you need to do 3 things. 1. Stop falling for these false safety nets. 2. Like the video. 3. Subscribe, because in that way, you won't miss my guide to the best potential setups. And let me know in the comments, what safe strategy are you now questioning after watching this video? Tell me, I want to hear. Trading is not about avoiding all risk. It's about taking intelligent risks with positive expected value. Start thinking like a poker pro, not like the sheep that follows your favorite trading guru off the edge of the cliff. Think you can manage that? Nice one. I'll see you in the next video then.